Ladies and gentlemen, we are now entering the final countdown. We have exactly 72 hours until the entire global silver market fractures into pieces that can never be reassembled. My name is Marcus Steele, known to many of you as the Vault Watcher, and what I am about to share with you is not speculation, not theory, not hopeful thinking. This is mathematical certainty wrapped in industrial panic and confirmed by data that Wall Street is desperately trying to hide from your view. Right now, at this very moment, as I speak these words to you, the price of silver exists in two completely separate realities. One reality lives on your computer screen, glowing softly at $72.15 per ounce, according to the COMEX exchange in New York. That is the number CNBC will show you. That is the number your broker will quote you. That is the number that financial textbooks will tell you represents the fair market value of silver. But here is what they are not telling you. That number is a lie. It is a phantom. It is a digital ghost haunting a system that died 3 days ago but refuses to stop twitching. The second reality, the one that matters, the one where actual human beings with actual money buy actual metal that they can touch with their hands, that reality is telling us a completely different story. In Shanghai, where the largest physical silver exchange on planet Earth operates, silver closed its last trading session at $84.55 per ounce. Not $72, $84. In Dubai, where Middle Eastern sovereign wealth funds and industrial conglomerates acquire physical metal by the metric ton, dealers are quoting $79.61. In London, at the vaults beneath the city where European old money stores its wealth, premiums have exploded to $8 over spot. Let me say this clearly, so there is no confusion, no ambiguity, no room for misinterpretation. There is no longer a single price for silver. The unified global market that has existed for 40 years has split down the middle like a cracked mirror. On one side, you have the paper price, the screen price, the fake price that exists only in the computer systems of banks who sold metal they do not own and cannot deliver. On the other side, you have the physical price, the real price, the price that people who actually need silver to build products or preserve wealth must pay to obtain the actual metal. These two prices should be identical. The fact that they are separated by $12.40, a 17.2% spread, tells you that something fundamental has broken. Arbitrage is dead. The bridge between these markets has been burned, and New York has become an island of paper floating alone in an ocean of reality that is about to drown it. In the next 30 minutes, I'm going to walk you through 3 layers of evidence that prove beyond any doubt that we are watching the greatest market dislocation in precious metals history unfold in real time. Let us examine these 3 levels with surgical precision, because the devil is always in the details, and the details right now are screaming at us. Level 1 is what I call the panic price. This is Shanghai. This is the Shanghai Futures Exchange, the largest physical silver trading venue in the world, handling more real metal delivery in a single month than COMEX handles in an entire year. Silver futures for February delivery closed at $84.55 per ounce. Who is buying at this price? It is not speculators. It is not hedge funds gambling on momentum. The buyers at $84.55 are Chinese solar manufacturers who need silver paste to print photovoltaic cells. They are electric vehicle battery producers who need silver for cathode contacts. They are state-owned strategic reserves managers who have been given explicit orders from Beijing to acquire and secure 6 months of industrial supply before the export licensing system goes live and the flow of silver out of China gets choked down to a trickle. Why are they paying $84.55 when the screen in New York says $72.15? Because they know something you do not know yet. They know that in 72 hours, it will not matter what the COMEX screen says. They know that once those export licenses become mandatory, once the Chinese government places 44 approved companies between Chinese refiners and the global market, once exporters must prove they produce at least 80 metric tons per year and hold credit lines exceeding $30 million, The arbitrage that has kept silver prices synchronized across continents for decades will simply cease to exist. So they are front-running the ban. They are paying 17% over Western prices today because they know that in 4 days, Western prices will be irrelevant to them. This is the price of the real world. This is the price of metal that moves, metal that ships, metal that arrives at your factory gate in physical form. Level 2 is what I call the honest price. This is Dubai. This is London. This is Switzerland. These are markets where paper contracts can be converted into physical delivery without requiring a team of lawyers and a 6-week administrative delay. In Dubai, over-the-counter dealers serving Gulf sovereign wealth funds are quoting $79.61 for immediate delivery of 1,000-ounce bars. This is not a panic price. This is not a front-running price. This is simply the fair value of physical silver when you remove the leverage, remove the derivatives, remove the fractional reserve game that COMEX plays. $79.61 is what silver costs when you deal in reality. Notice that it is still $7.46 higher than the COMEX quote. That spread should not exist. In a functioning market, arbitrageurs would buy COMEX silver at 72, ship it to Dubai, sell it at 79, and pocket a $7 profit per ounce. The fact that this arbitrage is not happening, that the spread persists and widens, tells you that physical delivery from COMEX has become either impossible or prohibitively difficult. Level 3 is what I call the zombie price. This is COMEX. This is the New York Mercantile Exchange, where silver futures trade on screens, where contracts are opened and closed with a click, where 99% of all trading is settled in cash rather than metal. The official closing price was $72.15. This is the price that financial media reports. This is the price that appears in databases and charting software. But this price has become completely detached from physical reality. Let me show you the mathematics of why this is unsustainable. The spread between Shanghai and COMEX is $12.40. Take $84.55. Subtract $72.15. You get $12.40. Now divide that spread by the COMEX price. 12.4 divided by 72.15 equals 0.1718. Multiply by 100. You get 17.2%. That is the premium that physical buyers in China are paying over paper sellers in New York. 17.2%. To put that in perspective, normal arbitrage spreads in silver are measured in pennies, not dollars. A spread of 30 cents is considered wide. A spread of $1 triggers algorithmic trading systems to exploit it. A spread of $12 should create a stampede of arbitrage traders buying cheap COMEX silver and shipping it to expensive Shanghai buyers. The profit is so large, so obvious, that every bank on Wall Street should be doing this trade right now. But they are not. Why are they not? Because arbitrage requires one critical thing. You must be able to obtain physical metal from the cheap market and deliver it to the expensive market. And right now, that is impossible. The Chinese export restrictions make it illegal to ship refined silver out of China without a government license. So you cannot buy Shanghai silver and ship it to New York. And the COMEX delivery system is so backed up, so strained, so depleted of available inventory that taking delivery of silver in New York and shipping it to Shanghai would require weeks of administrative processing, vault scheduling, and logistical arrangements. By the time your metal clears customs and arrives in Shanghai, the Chinese export ban will already be active, and you'll be stuck holding silver you cannot sell into the market that offered the premium. The bridge is burned. Arbitrage is dead. The phrase we keep using is critical to understand. Arbitrage is the mechanism that keeps prices synchronized across different markets. When arbitrage dies, prices drift apart. They decouple. They split into separate realities that no longer communicate with each other. New York becomes an island of paper. Shanghai becomes an island of physical metal. And the ocean between them is growing wider every hour. This is not a temporary dislocation. This is not a brief anomaly that will correct itself next week. This is a structural fracture in the global silver market that will define the next decade of precious metals trading. Now let me take you from the price spread to the volume data, because this is where the panic becomes quantifiable, measurable, undeniable. We need to look at COMEX delivery notices for January silver contracts. Delivery notices are formal requests from contract holders to take physical delivery of metal rather than rolling their contracts forward or settling in cash. On a normal day, in a normal month, especially in January, which is not a primary delivery month for silver, you might see 50 to 100 delivery notices. That is standard. That is typical. That is the baseline level of activity when markets are functioning normally. Recently, we saw 69 delivery notices issued. 69 contracts. Each silver contract on COMEX represents 5,000 troy ounces. So 69 contracts equals 345,000 ounces. That is 69 multiplied by 5,000. This number seemed like evidence that COMEX is primarily a speculative casino where traders gamble on price movements but have no interest in actual metal. 345,000 ounces is a rounding error compared to the size of the silver market. It is noise. It is meaningless. But then everything changed. The delivery notice count exploded. 1,847 contracts. Let me repeat that number because it is important. 1,847 delivery notices issued in a single day. Let us do the mathematics together because I want you to understand the scale of what just occurred. 1,847 contracts. Multiply by 5,000 ounces per contract. That equals 9,235,000 ounces. 9.235 million ounces in one day. Compare this to the previous baseline. The baseline was 345,000 ounces. The new number is 9.2 million ounces. Divide 9.2 million by 345,000. You get 26.7. That is a 27-fold increase in delivery demand in 24 hours. This is not a volume increase. This is not normal market growth. This is not a gradual trend. This is a raid. This is a run on the bank. This is the moment when holders of paper contracts decide they no longer trust the paper and demand physical metal instead. They're cashing in their chips while the casino is still open because they fear that if they wait until next week, the casino might close its doors. Who is behind these 1,847 contracts? We have partial data from the clearing reports. JP Morgan issued 100 delivery notices. Deutsche Bank issued 211 notices. These are not small retail traders. These are major financial institutions. These are the same banks that have been short silver for years, suppressing the price, selling futures contracts to dampen rallies, acting as the guardians of the paper price system. And now they are flipping. They are going long. They are demanding physical delivery. Why? Because they see the same data we are looking at. They see the Shanghai inventory drain. They see the Chinese export ban. They see the supply deficit. And they're scrambling to cover their positions before the music stops. Think about the psychology here. If you're a bank that sold 1,847 silver contracts, you did so expecting that the buyer would either roll the contract forward to a future month or settle in cash. That is how the game has always worked. 99% of futures contracts never result in physical delivery. The system depends on that. The system is designed around that assumption. COMEX does not hold enough silver in its vaults to deliver on even 10% of open interest if everyone demanded physical settlement. It is a fractional reserve system. It works as long as everyone agrees to play by the rules and settle in cash. But now the rules changed. Now 1,847 contract holders said we do not want cash, we want metal. And the banks that sold those contracts are now in a nightmare scenario. Where do you find 9.2 million ounces of silver today? Shanghai is closed to exports. Premiums in Dubai are $8 over spot. London vaults are being drained by Asian buyers. You are trapped. You sold something you do not have. You made a promise you cannot keep. And the clock is ticking. This volume spike is the mechanism that breaks the bank. When a paper market is suddenly forced to deliver physical assets at 27 times normal volume, liquidity evaporates instantly. The banks turn to the Federal Reserve. They borrow cash through the repo window. They use that cash to buy silver on the open market at inflated prices. They take catastrophic losses on every ounce because they sold contracts at $72, but now must buy metal at $84 to fulfill delivery. This is how paper markets die. Not with a regulatory announcement, not with a policy change, but with a sudden, violent demand for physical settlement that the system cannot meet. If the previous liquidity injection was a warning shot, then the current operation is a distress signal. The bleeding has not stopped. It is accelerating. The Federal Reserve conducted another emergency repo operation, injecting $2.8 billion into the banking system. Add that to the previous $3 billion. $3 billion plus $2.8 billion equals $5.8 billion. In 48 hours, the Fed has pumped $5.8 billion of emergency liquidity into banks. Let me repeat that figure 3 more times so it sinks in. $5.8 billion. $5,800 million. $5,800 million in 2 days. To understand the scale of this intervention, consider what $5.8 billion represents. It is more than the market capitalization of most mid-tier silver mining companies. It is enough money to purchase 80 million ounces of silver at current COMEX prices. 80 million ounces. And the banks burned through this amount in 48 hours just to remain solvent, just to keep their lights on, just to meet margin calls and delivery obligations. Why do banks need this money? Let me walk you through the mechanics step by step, because understanding this process is critical to understanding why the silver market is imploding. Step 1. Banks are short on paper, but physical metal. For years, J.P. Morgan, Citibank, Goldman Sachs, and other major dealers have sold silver futures contracts. They sold these contracts to hedge funds, to industrial consumers, to speculative traders. Each contract is a promise to deliver 5,000 ounces of silver at a specified price on a specified date. The banks sold these contracts without actually owning the physical metal, betting that the buyer would settle in cash rather than demand delivery. Step 2. Banks now face 2 choices. Choice A is to deliver metal from their own vaults. But if they do this, they deplete their reserves. They expose themselves to future delivery demands with no metal to back them. They also reveal to the market that their vaults are emptier than their balance sheets claim. This creates a loss of confidence. It triggers audits. It invites regulatory scrutiny. So choice A is undesirable. Choice B is to buy silver on the open market and deliver it to the contract holder. This sounds simple, but it is a financial disaster. Step 3. The problem with choice B. Let us use real numbers. The bank sold a silver contract at $72 per ounce. That was the price when the contract was written. Now the contract holder demands delivery. But silver is no longer $72 in the physical market. In Shanghai, it is $84. In Dubai, it is $79. Even in London, with an $8 premium, you're paying $80. So the bank must go into the market and buy silver at $84 per ounce to fulfill a contract they sold at $72. They lose $12 on every ounce. Multiply that by 5,000 ounces per contract. They lose $60,000 per contract. Now multiply by 1,847 contracts. That is $110,820,000 in losses. $111 million in a single day from 1 day's worth of delivery notices. Step 4. They are buying high and delivering low. This is the inverse of every trading principle. You're supposed to buy low and sell high. But when you're forced to deliver physical metal that you do not own, you have no choice. You buy at whatever price the market demands. You take the loss. You bleed cash. And if this continues for days or weeks, you bleed to death. Step 5. This destroys their cash reserves. Banks operate on leverage. They do not keep massive piles of cash sitting idle. They invest it, lend it, deploy it. When they suddenly need $111 million to cover silver delivery losses, they do not have it in their checking account. They must borrow it. And the only entity willing to lend banks emergency cash on 48 hours notice is the Federal Reserve. Step 6. They run to the Fed's repo window to borrow cash. The repo market is where banks go when they need short-term liquidity. They pledge collateral, usually treasury bonds, and borrow cash overnight or for a few days. In normal times, the repo market operates smoothly with minimal Fed intervention. But these are not normal times. The Fed has injected $5.8 billion in 2 days. That tells you banks are in acute distress. Now let me name specific banks and specific actions they have taken that confirm this crisis. JP Morgan increased its reserve for trading losses by $400 million overnight. You do not reserve $400 million for a sunny day. You do not add $400 million to your loss provisions because you're feeling cautious. You reserve $400 million because you know, with mathematical certainty, that a storm is already hitting your portfolio and the losses are real, immediate, and quantifiable. JP Morgan is preparing for catastrophic losses on its silver short positions. Citibank is experiencing unprecedented physical delivery requests that are overwhelming its settlement systems. We have heard reports from traders who placed delivery requests with Citibank and were told it will require administrative time. Administrative time is bank code. It is jargon. It means we do not have your silver in the vault, and we are frantically searching for it. A normal physical delivery from a major bank should take 2 business days. When they tell you administrative time is required, they are buying themselves weeks to locate metal they claim to have but do not. Bank of America has extended delivery timelines from 2 days to 2 weeks. Why the delay? They are scouring the market. They are calling London vaults. They are negotiating with ETF custodians. They're trying to find silver anywhere they can because their New York inventory is gone. The vault is empty. The registered silver that is supposed to back their short positions has been withdrawn, shipped to Asia, and converted into solar panels and EV batteries. It is not coming back. Now think about the timing of this liquidity drain. During holiday periods, repo markets are normally quiet. Banks want to close their books and send traders home. The Fed wants to enjoy a quiet end to the year. But the Fed is so active, banks are so desperately in need of cash during the holiday season, that it tells us the panic is acute. They cannot wait. They need money now. They need it today. Because if they do not get it, they will fail to meet delivery obligations, and the entire COMEX system will be exposed as a fraud. $5.8 billion is the invisible proof of collapse. The price on your screen says $72, so you think everything is calm. But the Fed's balance sheet says $5.8 billion, which screams the building is on fire. They're using a money hose to beat back the flames so the public does not see the smoke. But the smoke is there. You just need to know where to look. And we are looking. We see it. We are documenting it. And we are telling you the truth. While banks in New York are burning cash, trying to patch holes in their balance sheets, the situation in Shanghai has accelerated from a vacuum operation to total depletion. If you thought 41 metric tons withdrawn in a single day was a lot, wait until you see the updated numbers. Many thought that 41 tons was a one-time event, a strategic move by a single large buyer, perhaps a state entity, securing reserves. But subsequent data proves it was only the first wave. An additional 43 metric tons were withdrawn during the next trading session. Add the 43 tons to the previous 41 tons. That is 84 metric tons in 48 hours. 84 tons. Let us convert this into ounces because weight is abstract and ounces are concrete. 1 metric ton equals 32,150 troy ounces. 84 tons multiplied by 32,150 equals 2,706,000 ounces. 2.7 million ounces. Gone. Removed from registered inventory. Loaded into armored convoys. Driven into the darkness. Disappeared from the exchange vaults. To understand the velocity of this burn rate, consider the baseline. The Shanghai Futures Exchange normally sees withdrawals of 2 to 3 metric tons per day during normal trading conditions. That is the historical average. That is business as usual. Industrial consumers take delivery for manufacturing. Investors take delivery for storage. It is a steady, predictable flow. But now we are seeing 42 metric tons per day. 42. Divide 42 by 3. That is a 1,400% increase. 14 times normal. This is not industrial consumption. Factories do not suddenly need 14 times more silver overnight to produce solar panels. This is panic hoarding. This is strategic accumulation. This is entities with inside information preparing for a supply crisis that they know is coming. What is the impact on total inventory? Recently, Shanghai Futures Exchange registered inventory stood at 755 metric tons. We were already worried then. Inventory had been declining for months. 755 tons was a multi-year low. But after 2 days of withdrawals, we are down to 727 metric tons. That is a loss of 28 tons in 2 days. Now, let us think about the mathematics of this trajectory. They are draining approximately 3.5% of total exchange inventory every single day. If this rate continues, and there is no reason to believe it will stop, the Shanghai Futures Exchange will be mathematically empty in less than 1 month. 0. No metal left. Every ounce withdrawn, shipped, and locked away in private vaults or factory warehouses. But it will not take a month. Markets do not go to zero in a straight line. They snap. When inventory falls below a psychological threshold, usually around 500 tons for Shanghai, panic accelerates. Buyers realize there will not be enough for everyone, so they double their orders. They triple their orders. The run on the vault becomes exponential. We are watching the beginning of that exponential curve right now. The first phase of a bank run is orderly. People line up calmly. They withdraw their deposits. They walk away. But when the line gets long enough that people at the back realize the vault might be empty before they reach the teller window, the line turns into a mob. People start pushing. They start running. And that is when the system collapses. Who is taking this metal? You have to ask yourself this question. Who withdraws 84 metric tons of silver in 2 days? This is not a retail investor buying a few coins for his safe. You do not withdraw 84 tons in coin form. This is state-level activity. This is China's Strategic Reserve Bureau. This is battery conglomerates like CATL and BYD. These are solar manufacturers like Jinko Solar and Trina Solar. These are entities with inside information. They know exactly how strict the new export licensing rules will be. They know which companies will receive licenses and which will be shut out. They know that once the licenses go live, the flow of silver into and out of China will be controlled by bureaucrats in Beijing, not by market prices. So they are acting now, while the market is still open, while metal is still available, while they can still execute large orders without government interference. This creates a terrifying feedback loop for the West. Every ounce that leaves Shanghai's vault is an ounce that can never be arbitraged back to London or New York. It is an ounce permanently removed from the global float. Western banks, the ones we discussed who are short millions of ounces, are watching this inventory drain and sweating. They were counting on this metal. They hoped that maybe, just maybe, China would export some silver to cool global prices and relieve the supply squeeze. But China is doing the exact opposite. They are locking it down. They are building a wall around their domestic supply. And they are leaving the rest of the world to fight over scraps. This hoarding is not happening only at the exchange level. It is trickling down to the corporate level. Panic has spread from state vaults to factory floors. For the last 20 years, the entire global manufacturing system has operated on a philosophy called just-in-time inventory management. It is a beautiful system when it works. You do not hold inventory. You do not pay for storage. You do not tie up capital in raw materials sitting in a warehouse. Instead, you order exactly what you need for this week's production, and the truck arrives at your loading dock exactly when the assembly line needs it. It is efficient. It maximizes cash flow. It minimizes waste. But just-in-time has a fatal flaw. It relies on an assumption. The assumption is that you can always get what you need at the expected price when you pick up the phone. Today, that assumption died. Let me give you concrete examples from the corporate world that prove panic is no longer limited to traders and banks. Samsung, one of the world's largest consumers of silver for electronics and high-tech battery applications, has reportedly executed emergency purchase orders to secure 6 months of silver supply in advance. Think about the scale of this shift. Normally, a company like Samsung holds maybe 2 weeks of inventory, just enough to keep production lines running smoothly without tying up excessive capital. Overnight, they decided to hold 26 weeks. They are effectively removing 6 months of demand from the market today. Why? Because they see the same data we are looking at. They see the 84-ton drain in Shanghai. They see the export ban approaching. And they know that without silver, they cannot manufacture a single circuit board, a single display screen, a single smartphone. For Samsung, paying a $5 premium or even a $10 premium per ounce does not matter. Silver represents a tiny fraction of the cost of a smartphone. Maybe $2 worth of silver goes into a high-end phone that retails for $1,000. But the cost of zero silver is bankruptcy. The cost of zero silver is shutting down factories, laying off workers, breaching contracts with retailers, losing market share to competitors who secure their supply. So Samsung is paying whatever it takes to guarantee delivery. And by doing so, they're telling the market that the COMEX price is irrelevant. They are voting with their wallet, and their vote says silver is worth whatever it costs to keep the factory running. We have seen reports of internal memoranda from Tesla's procurement department, specifically related to their solar roof segment and EV battery production lines. The memos reportedly label current silver inventory levels as critical. The word critical in corporate procurement language is the highest alert level. It means we are at risk of production stoppage. But more importantly, the memo reportedly authorizes purchasing managers to pay above spot price to secure immediate physical delivery. Read that again. Tesla is telling its buyers to ignore spot price and just get the metal. When a company like Tesla, run by Elon Musk, who is famously obsessed with cost efficiency, tells procurement to pay over spot, that tells you spot price has become meaningless. That tells you the real price, the price that clears the physical market, is higher than the paper quote. And Tesla is acknowledging this reality, even if COMEX refuses to. Now let us talk about Chinese solar giants. We know that China controls 80% of global solar panel production. We know that the new Topcon solar cell technology uses 50% more silver than older panel designs. What do you think Chinese solar manufacturers are doing right now, hours before their own government locks down the export market? They're vacuuming up domestic supply. They're the ones standing in line at the Shanghai Futures Exchange demanding delivery. They are ensuring that while the rest of the world starves for silver, China will have enough to dominate the energy transition for the next decade. This is not just about market positioning. This is about industrial strategy. This is about controlling the supply chain for the technologies that will define the 21st century. And China is winning. But the fracture between paper price and physical reality is not just happening in corporate boardrooms. It is happening on Main Street. It is happening at your local coin shop. It is happening at major online bullion dealers. If you think the price of silver is $72.15 because that is what the ticker on CNBC says, I challenge you to try to buy an ounce for $72. Go ahead. Try. You cannot. Let's look at premiums on American Silver Eagles, the standard U.S. government-issued coin. If you want to buy a Silver Eagle right now, you are not paying $72. Current premiums on Silver Eagles have exploded to $12 over spot. That puts the real purchase price of an Eagle at approximately $84. Does that number sound familiar? Because $84 is the exact price that silver is trading at in Shanghai. Do you see the convergence? The paper price in New York says 72, but the physical price in Shanghai is 84. And the physical price at your local dealer is 84. The market has already repriced silver. The only entity that has not admitted it yet is COMEX. Let's look at Canadian maple leaf coins. Normally, maples trade with a $2 to $3 premium. Today, the premium is $10. Let us look at generic silver rounds, just basic chunks of silver with no collectible value, no government backing, no fancy design. Generic rounds are trading at $8 over spot. Normally, generics trade at 90 cents over spot. An $8 premium on generic silver is an 800% increase in the cost of physical acquisition. This is the market screaming at you. This is supply and demand in its rawest form. There is not enough physical silver to meet demand at $72. So the price adjusts. But it does not adjust on the COMEX screen. It adjusts in the premium. Why are dealers charging these premiums? Because dealers know they cannot replace their inventory at $72. They know that if they sell you a coin today, they might have to pay $80 to restock it next week. So they are pricing the future. They are pricing scarcity. They are pricing risk. They are effectively saying the spot price is fake, and if you want this metal, you pay the real price. We are hearing reports that major wholesalers, the ones who supply APMEX and JM Bullion and other large online retailers, are halting sales. They are pulling inventory off their websites. You will see out-of-stock buttons everywhere. Or worse, you will see pre-order, estimated shipping 6 weeks. 6 weeks is code for we do not have this, and we are hoping to find it before you sue us. When wholesalers stop selling, it means they believe the replacement cost will be higher than today's selling price. It means they would rather hold inventory and wait for prices to rise than sell at current levels and lock in a loss. Connect everything together. Samsung is buying 6 months of supply to keep factories running. Tesla is frantically securing critical inventory. China's solar sector is draining Shanghai vaults. And the retail market is charging a $12 premium just to release a single coin. This is total rejection of the paper price. The entire world, from billionaire CEOs to small stackers, is voting with their wallets. And their vote says silver is worth $84, not $72. We have exposed the $5.8 billion emergency liquidity that the Fed used to prevent the banking system from collapsing. But now we must stop looking backward and start looking forward. We are staring at some of the most dangerous hours in silver market history. Markets are approaching a critical juncture when China's export ban becomes active law. That is when the supply chain officially locks. But markets do not wait for news. Markets front-run news. So I'm going to walk you through exactly what is unfolding. The first phase is what I call the last train. This is the final window of liquidity before major changes take effect. This is the last chance for paper shorts to cover positions before the rules change. And this is the last chance to secure physical metal before premiums explode again. If you're watching price action, do not be surprised if you see violent moves. Banks might try to smash the price down to $70 to trigger stop losses and shake out weak hands. Or they might capitulate and send it higher. But the price does not matter. What matters is ownership. Once the regulatory changes take effect, the doors are locked. The train leaves the station. And if you're not on board with physical metal in your possession, you are left standing on the platform. The second phase is what I call the void. This is when markets close for holidays. Screens are dark. The ticker is silent. But do not make the mistake of thinking nothing is happening. Behind the scenes, this will be one of the most stressful periods in precious metals trading system history. While the public celebrates, risk managers at JP Morgan, Citibank, and Goldman Sachs will be in emergency conference calls. They will be staring at the 84-ton hole in Shanghai inventory. They will be staring at 1,847 delivery notices. And they will realize they need to find 9 million ounces of silver that simply does not exist. This is the period when industrial panic goes into overdrive. This is when the CEOs of Samsung and Tesla make calls to refiners. This is when over-the-counter deals happen in the darkness. They will bid for metal in the shadows. They will pay premiums that would make your head spin just to secure delivery before markets reopen. We will not see these prices on the chart, but we will feel them when trading resumes. The third phase is what I call Silvergeddon. Markets reopen. China's export ban is now active. Licenses are required. Borders are sealed. And the market realizes arbitrage is mathematically impossible. Here is my prediction for what happens. I believe we will see a gap up of historic proportions. The paper market in New York cannot maintain its previous price when a physical market in Shanghai is trading significantly higher and delivery is cut off. The algorithm will try to close the gap instantly. We might see silver jump dramatically. It will try to teleport to the real price. But price is not the danger. The danger is force majeure. Watch carefully for announcements when markets reopen. I believe we will start seeing notices from smaller bullion dealers and possibly even some industrial suppliers declaring force majeure. That is a legal term meaning unforeseen circumstances prevent us from fulfilling the contract. It is a polite way of saying we are defaulting. They will tell customers we cannot deliver your silver because regulations changed. They will offer cash settlement. They will say, here is your $72 back. But the customer does not want $72. The customer wants metal that is now worth $84. This is when class action lawsuits begin. This is when the paper market loses all credibility. And watch the premium spread. If the spread is $12.40 now, do not be shocked if it reaches $15 or $20 when trading resumes. Why? Because while the paper price tries to climb, the physical price will run away from it. Dealers will go into no offer mode. You will call to buy silver, and they will say we have no inventory. Or they will say price is spot plus 20. Spot price will become a museum exhibit, a number that exists only on a computer screen in New York, completely divorced from the reality of buying and selling real metal. We are witnessing the final wealth transfer. For 40 years, wealth was stolen from physical holders by paper manipulators. They used leverage to suppress price and hide real value. But now gravity turns on. China has removed the physical buffer. The Fed has exhausted the liquidity buffer. And industrial buyers have exhausted the inventory buffer. There are no buffers left. All that remains is the naked truth of supply and demand. So this is my final message to you. Do not look at red candles and feel fear. Look at them and feel pity. Pity for the people selling real assets for paper currency that is being printed by the billions to cover banking insolvency. You're on the right side of this trade. You're holding the asset that Samsung needs, that Tesla needs, and that China is hoarding. You're holding an asset that cannot be printed, cannot be hacked, and cannot be defaulted on. The era of paper silver is ending. The era of strategic silver is beginning. Hold tight, stay safe, and prepare for the revaluation of your lifetime. This is Marcus Steele from the Vault Watcher. Warning delivered. Timeline established. The mathematics are undeniable. The data is screaming. And we are watching history unfold in real time. Like, subscribe, and share this video. The world needs to know what is happening. The truth cannot be suppressed any longer.